Hi, I'm Vinay Ranjan, and today I'll be covering portfolio holding Mineral Resources, which is a company operating in the resources sector. Mineral Resources is at its core a mining services company. They provide crushing, mineral processing, and a suite of infrastructure services to mines like haulage and ship loading. It's what the company would describe as a complete pit-to-port solution. Over time, the company has also expanded into acquiring undeveloped resource assets and bringing them into production and putting in place the complete mine infrastructure. So as it stands today, the business comprises a mining services company and a portfolio of commodity assets spanning lithium, iron ore and gas. The reason we like the company at Airlie is because we think it's a high quality business operating in an unloved sector. And we say high quality because when you look at the track record of this business, it has generated on average an after-tax return on invested capital of 27% since listing. And when you consider the average ASX 200 industrial company has a return on capital of just 10%, that tells you this is an exceptional company with a unique or advantaged business model that allows it to earn almost 3 times the market return. And you might ask, well, why does return on capital matter? And there's this wonderful quote from Charlie Munger where he says, if a business earns a 6% return on capital over 40 years and you hold that business for 40 years, you're not going to make much different than a 6% return. So over time, if your return is going to approximate the return of the underlying business you're invested in, we think it pays to be invested in really high return on capital businesses. And Mineral Resources is a terrific example of this, where the total shareholder return has been about 32% per annum, roughly in line with that 27% return on invested capital. We think Mineral Resources has developed a unique business model which differentiates it from both traditional miners and mining services companies. As I mentioned earlier, Mineral Resources has moved into acquiring and developing resource assets. Now, the intention here is not to be a miner and own the underlying commodity, but rather to build a pipeline of future work for its mining services business. So I'll expand on that a bit further. Typically once the mine has been fully developed, Min will look to sell down part of its ownership to a joint venture partner. Now they may well realise a profit on that sale, but more importantly, as part of the sale agreement, they will negotiate to retain a life of mine contract to provide mining services to that mine, effectively locking in an annuity income stream. Meanwhile, the capital realised from the asset sale can be recycled into a new project, and once that mine is fully developed, hopefully will result in another annuity mining services contract, and the process goes on. So we think this is a really unique approach, and it's the reason why the company has been able to consistently generate those high returns on capital over a long period of time. In contrast, a traditional mining services company relies on lumpy, one-off contracts which require significant capital investment without the certainty of long-term returns. We still see significant opportunity for growth in the company. While Mineral Resources is currently benefiting from tailwinds in commodity prices for both iron ore and lithium, we think they've got multiple projects in the pipeline which will generate attractive returns even if commodity prices were to fall significantly. And I'll touch on 2 of those projects in more detail. The first is the move downstream into lithium hydroxide production. So Min jointly owns 2 of the world's largest hard rock lithium deposits in Mount Marion and Wodgina. While those assets are generating meaningful profits today, there is an additional profit pool available if they can convert the lithium spodumene, which is the ore itself, into lithium hydroxide, which is the end product used in lithium batteries. Min is currently in the process of building out these conversion plants, and they expect to have capacity to produce over 100,000 tonnes of lithium hydroxide over the next couple of years. If you take the current lithium hydroxide spot price of $60,000 a tonne, that implies a $6 billion revenue opportunity in lithium at very attractive margins. The second growth opportunity is the Ashburton iron ore project. For a long time, Min has been viewed as a marginal player in iron ore due to its low-grade, high-cost tonnes. The Ashburton iron ore project, which is due to be completed in 2024, is a low-cost operation capable of producing 30 million tonnes per annum, which is more than double Min's current iron ore production. Interestingly, that project is going to be split into both a mine co and an infrastructure co, with the latter consisting of a private haul road and a ship loading facility. We expect there will be opportunities for Min to realise some value via partial asset sales of both of these entities once they're fully up and running. So overall, we think the earnings from these two opportunities have the potential to eclipse the earnings from the entire business today.